The Dow just printed 52,182.74. That is a 0.59% gain, meaning we just crossed 52,000 for the first time in history. The S&P 500 added 1.18% to finish at 7,440.43. And the Nasdaq absolutely roared, up 2.07% to close at 25,820.42.
Right. The closing bell rang exactly 15 minutes ago. And, on paper, that closing print looks like a massive key reversal. We just snapped a brutal 5-day losing streak.
Yeah, the headlines tonight are going to scream that the bulls are back in control. But for you, the active trader listening to this deep dive, you can't afford to just trade the headline. We were digging into the raw institutional briefings from this Monday session to figure out what actually drove the tape today.
Because if you just stare at the green flashing on your screens, you are missing the structural reality of the market right now. You have to look at the narrative, the why behind this sudden surge.
So let's get right into that narrative. The briefings point to a big confluence of events over the weekend, mainly geopolitical de-escalation with the U.S. and Iran resuming talks in Doha.
Exactly. And the immediate mechanism there is the energy complex. The second that geopolitical risk premium evaporated, we saw Brent crude cool off instantly. It dropped down to $73.91 barrel.
Which is huge for input costs.
Right. Oil drops, corporate costs drop, and the immediate inflation panic it just eases up a bit. That took the pressure off equities. And you combine that with this colossal corporate M&A boom that hit the wire today. It gave the market proof that corporate animal spirits aren't dead yet.
Okay, but I have to push back here. Because look at the calendar. We are heading into a holiday-shortened week. The market is closed this Friday for the 4th of July.
Yeah, desk activity is already getting really thin.
Right. So is this actually a structural breakout where you want to commit fresh capital, or is this just a low-liquidity head fake?
I am leaning heavily toward a head fake. And the volume confirmation, or really the complete lack of volume confirmation, backs that up. If you strip out the specific M&A volume, broad institutional participation was practically a ghost town today.
But what was actually doing the buying?
A textbook combination of end-of-quarter window dressing and programmatic algorithmic buying, pushing things into the close.
Let's break down that window dressing concept real quick for anyone who maybe just focuses on the technicals.
Sure. So tomorrow is the final trading day of Q2. Institutional portfolio managers have to send their quarterly reports to their clients, right?
Right.
Well, if tech has been running hot, but they missed the rally, they are essentially forced to buy those specific winning names right at the buzzer. They want those tickers on their balance sheets to look smart for their clients. It's totally artificial. It's forced buying that has nothing to do with actual long-term conviction.
And the intraday action perfectly aligns with that, doesn't it? The S&P had a nasty mid-morning stumble. We had some hot inflation data hit the terminal, peaked above 4%. And by 11:45 a.m., the S&P was only up like 0.8%.
Yeah, it really looked like the rally was going to fade hard.
But then the buy programs they woke up.
They stepped in aggressively. When liquidity thins out because human traders are hitting the road for the Hamptons, algos can just easily take control of the tape. They didn't let that morning gap fade. They bid it all the way up into the final bell. But look, you cannot mistake a low-volume algorithmic squeeze for broad, real money accumulation.
Which brings up a glaring red flag in today's internals. The breadth was just deeply concerning.
It's probably the most important metric to understand from today's session, honestly.
Yeah, so the market cap weighted S&P 500 rose 1.18%. But if you pull up the equal weight S&P 500 ETF of the RSP, it barely budged. It gained a meager 0.20%. And the small cap Russell 2000 actually closed in the red.
Totally flat or negative.
Meanwhile, the Vanguard Mega Cap Growth ETF, MGK, leaped 2.6%. I always think of market cap weighting like a corporate board meeting where your vote is based entirely on your share count.
That is exactly how you should think about it. Apple, Microsoft, NVIDIA, they own all the voting power, so they vote to take the market higher. The index goes up.
But the equal weight index is a pure democracy. One company, one vote. And today, the Democratic vote essentially said the market was flat. Are these mega-cap tech giants just actively masking a highly fragile market?
They absolutely are. It is extreme concentration risk. The Magnificent Seven and the semiconductor sector literally put the entire index on their backs today.
Which is wild because just last week, we were seeing some healthy rotation, right? Capital was flowing out of tech and into defensive materials and small caps.
Right. It looked like things were finally broadening out. But today, all of that evaporated. Materials shed 0.16%, and all that capital funneled aggressively right back into the most crowded tech trades.
Okay, so if the foundation is that fragile, it perfectly explains the total anomaly we're seeing in the volatility space today.
The VIX.
The VIX, the fear gauge. It only dropped 0.98% today to close at 18.23. I mean, if the NASDAQ rockets up 2%, historical precedent says the VIX should get completely crushed. Why is it so stubbornly elevated?
Because options dealers are flat out refusing to take off their armor. To really see the mechanics, you have to look past the headline VIX and look at the spread between the VIX and the VXN.
And just to clarify, the VXN is the volatility index, specifically for the tech-heavy NASDAQ 100.
Precisely. Today, the spread between the VXN and the VIX blew out to 12 points. Our institutional sources are flagging that this is the widest that margin has been in 23 years.
Wait, 23 years?
Yeah, it's a massive divergence.
So unpack the mechanics of that spread for us. How does it actually widen out like that in real-time trading?
Well, both of these indexes are calculated based on how much institutional traders are paying for options, right? Specifically put options, which are just insurance against a market drop.
Okay.
A 12-point spread means institutions are paying exorbitant premiums specifically for NASDAQ put options, while the broader S&P 500 insurance remains relatively cheap.
Because they know tech is the only pillar holding this whole thing up.
Exactly. If tech cracks, the entire structure comes down. So they are aggressively hedging their tech exposure ahead of a massive macro week. I mean, we've got Fed Chair Kevin Warsh speaking in Sintra, and the June non-farm payrolls report hits on Thursday.
Right, so they simply don't trust this breakout. They're keeping their hedges firmly in place. But, I mean, even with all that skepticism, the specific catalysts driving those tech pillars today were massive. Let's look at the individual names that generated the wildest price action, starting with what looks like a semiconductor rescue mission.
Rescue mission is definitely the right phrase. Chip equipment stocks were getting decimated last week. Everyone was terrified that AI valuations had just completely detached from reality.
But then today, Applied Materials ticker AMAT surges 11.5%. KeyBank came out and aggressively raised their price target on AMAT from $550 all the way to $750.
That's a massive revision.
It is. They published this deep dive citing a durable, multi-year AI equipment cycle. And then you combine that note with the breaking news out of Asia. Samsung and SK Hynix just announced a $518 billion chip-making hub in South Korea.
$500 billion of physical capital expenditure. That is not just hype.
Exactly. The secular AI hardware trade was instantly revived on that news.
And we saw the ripple effect immediately across the tape. That AMAT breakout dragged NVIDIA up 1.3%, and it pulled the broader PHLX semiconductor index from being down 2% in the morning all the way to closing up 3.8%.
Incredible swing.
Yeah. The mechanism here is real capital deployment. When institutions see $518 billion being committed to physical foundries, it proves the AI build-out requires massive, sustained hardware infrastructure. So they stepped in, they bought the dip because they believe this supercycle is just consolidating.
And it wasn't just semis. The corporate M&A action today was equally wild. Let's look at Rocket Lab, ticker RKLB. It gapped up 15.96% on exploding volume, closing at $97.95.
That chart is something else today.
Yeah, they announced an $8 billion deal to acquire Iridium Communications for $54 a share.
Which completely changes the underlying thesis for Rocket Lab. I mean, they aren't just a launch provider anymore. By absorbing Iridium's 2.5 million active subscribers, they are transforming into a vertically integrated space communications titan overnight.
And the strategy briefings we're looking at are actually flagging RKLB as a prime day 2 play for tomorrow. Because it consolidated so tightly near its highs into the close, institutional desks are watching for a breakout past $99, looking to test that massive $100 psychological level.
Though they are treating it with tight risk management, the briefing notes a strict stop loss at $94.50.
Right, it's a clean setup. But I want to pivot to a situation today that was anything but clean. Let's talk about the total retail trap that unfolded with Comcast, ticker CMCSA.
Oh, this was brutal to watch.
Comcast announces a massive tax-free spinoff of their NBC Universal and Sky Media assets. On paper, this is exactly what activists have been demanding for years to unlock shareholder value.
Yeah, it's a great headline.
Retail traders see it, momentum goes wild, and the stock surges 25% in the pre-market. It touched highs near $28.41. But what happens when the 9:30 a.m. cash bell actually rings?
The stock immediately craters. It is the absolute classic sell the news mechanism.
So break down how that actually works on the floor. Why does universally good news lead to a massive dump at the open?
Because institutional smart money operates entirely on liquidity. When retail traders flood into a stock in the illiquid pre-market session, they drive the price up to completely unsustainable, euphoric levels.
Right, there's no volume to absorb it.
Exactly. So institutional desks look at that $28.41 price tag. They realize it is mathematically overvalued based on the sum of the parts valuation of the spinoff. So what do? They use that massive wave of retail buying as their own exit liquidity.
Wow.
The second the primary market opens, institutions dump millions of legacy shares onto those retail buyers, just flushing the stock down. Comcast ultimately closed at $24.60. It was up only 6.15% on the day. So if you bought that pre-market top, you are deeply, deeply underwater right now.
It's a harsh lesson in market mechanics. Now, the institutional briefings are looking at Comcast as another day two play, but this time betting on a slow grind recovery as analysts actually sit down and recalculate the new valuations.
But Comcast wasn't even the most counterintuitive move of the session. I mean, the award for the most brutal mechanical dislocation today has to go to Verizon, ticker VZ.
Ah, the passive index trap. This situation is honestly mind-blowing if you are just trading off fundamentals.
It really is.
Verizon announces a major 50-50 international enterprise joint venture with BT Group. It's a massive win for their enterprise division. The stock pops over 1% in the pre-market. Everything looks great, but then the open hits, and the stock completely collapses. It closes down 5.11% to $44.16 on just exploding volume.
Unbelievable volume.
Yeah, 47.9 million shares traded today, which is 93% above its three-month average.
It is a masterclass in why structure always beats sentiment.
So explain the plumbing here. Why did a fundamentally positive news catalyst get completely ignored by the market?
Because today was the official implementation date for the reconstituted Dow Jones Industrial Average. Weeks ago, the index committee announced that Verizon was being deleted from the Dow. And when a stock is deleted from a major index, every single passive mutual fund and ETF that tracks that index is legally obligated to sell their shares of that stock on the effective date.
So they literally have no choice.
Zero choice.
Yeah.
The portfolio managers at Vanguard or State Street, they aren't sitting around debating the merits of this new BT Group joint venture. They don't care about the fundamentals. They don't care about the dividend yield. They don't care about the forward guidance.
Right. The algorithm just takes over.
The algorithm simply says, Verizon is no longer in our tracking index. Liquidate the position to maintain tracking accuracy. Today, passive institutional desks were structurally forced to dump tens of millions of shares onto the open market. That mechanical, forced selling completely overwhelmed any fundamental buyers who liked the BT news.
So if you're a retail investor trying to trade the news today, you were just standing on the tracks in front of a passive investing freight train.
Exactly. When index funds are forced to rebalance, fundamentals simply do not matter in the short term. The plumbing dictates the price.
That brings us to the most critical part of this deep dive. We've dissected the scoreboard, we look at the weak breath, the options fear, this forced selling trap. For the active trader listening right now, how does this institutional data set up tomorrow's final Q2 session and the rest of the week?
The institutional game plan is heavily focused on key technical levels right now. Today's aggressive afternoon surge forced a breakout past the 7,415 trigger level on the S&P 500. Because the buy program sliced through it with such velocity that 7,415 level has now flipped. It was previous resistance. It is now your short-term structural support.
Right, so the primary asymmetrical trade the briefing lays out is buying the dip on the S&P 500 if we see a pullback to retest that 7,415 level. The target is a momentum run up to the 7,500 psychological barrier. But they're explicitly warning against naked longs here. You have to use strict risk management.
You set a hard mechanical stop loss at 7,370. That gives you a highly favorable 1.9 to 1 reward to risk ratio.
Let's zoom in on that 7,370 level because the briefing refers to it as the line in the sand, the gamma wall. For a listener who doesn't trade options professionally, what exactly is a gamma wall and why is it the absolute floor for the S&P right now?
To understand a gamma wall, you have to look at how options dealers manage their own risk. When retail traders and hedge funds buy massive amounts of put and call options, the dealers selling those options take on enormous directional risk, right?
Yeah, they have to hedge it.
Exactly. To stay neutral, those dealers are constantly buying and selling the underlying S&P futures. A gamma wall at 7,370 means there is a massive cluster of options expiring at that exact strike price. As long as the market stays above it, dealers are forced to buy the dips to balance their books, which artificially supports the market.
Okay, but what happens if the selling pressure is too heavy and we actually break below 7,370?
The math violently reverses. Below that wall, the dealer's exposure flips. To hedge their risk, they are mechanically forced to start shorting the market as it
Oh,
drops.
wow. So they add to the selling pressure.
Right. They go from being the market's biggest buyers to its most aggressive sellers. If 7,370 cracks, there is a complete lack of structural support. It opens a trapdoor, and there is practically nothing to catch the falling knife until the 50-day moving average, which is sitting way down near 7,363. You hold 7,370, the bulls stay in control, you crack it, you step aside, or you get short.
And hanging over all of these technical levels is a massive macro collision waiting to happen. While equities were partying today, the bond market was telling a very different story.
It always does.
The 10-year Treasury yield is currently sitting consolidated at an elevated 4.38%, and the futures market is shifting hawkishly. Bank of America strategists actually released a note today warning that we could see up to 3 rate hikes this year under Fed Chair Kevin Warsh.
This is the absolute elephant in the room. We have a massive divergence right now. Mega cap tech multiples are expanding, meaning investors are willing to pay higher and higher premiums for future earnings, while bond yields are screaming higher for longer.
All right, let's break down the math on that. If you are valuing a growth stock, you use a discounted cash flow model. You project their future earnings and discount them back to today's value using a risk-free rate, which is heavily influenced by that 10-year Treasury.
Yep.
So if the 10-year yield is staying elevated or even rising with potential rate hikes, those future earnings are mathematically worth less today. Physics dictates that expanding tech multiples and rising yields have to violently collide eventually.
You are 100% right on the mechanics. They will collide. But timing that collision is the hardest trade in finance. Right now, the equity market is completely ignoring the hawkish shift in bonds because of sheer momentum. Statistically, when a trend day of today's magnitude snaps a 5-day losing streak during a broader macro bull market, the probability of continuation on day 2 sits around 58% to 62%.
So the technical trend heavily favors the bulls for tomorrow's open.
It does. But the macro backdrop demands tight position sizing. Tomorrow is the final day of the quarter. Rebalancing pressures will be immense. You cannot chase morning gaps. You have to expect early attempts to push new highs, followed by violent midday chop as institutional desks finalize their quarterly books and prepare for Thursday's payroll data.
Let's pull all of these threads together. Today was historic. The Dow broke 52,000 for the first time ever, hitting 52,182.74, and it was fueled by algorithmic buy programs, massive capital expenditures in AI hardware, and a collective sigh of geopolitical relief regarding crude oil.
But beneath the shiny index numbers, the breadth was incredibly fragile.
Exactly. Equal weight and small caps sat out the rally, and the volatility spread between the Nasdaq and the S&P blew out to the widest margin in 23 years. The indices are being propped up by a handful of semiconductor and tech giants, while options dealers frantically buy insurance against a tech collapse.
It is a tape that demands precision, not blind optimism. You have to respect the momentum, but you have to respect the gamma levels even more.
Which leaves us with a really fascinating structural question to ponder. We talked at length about the Verizon index trap, how algorithmic, passive forced selling completely annihilated a stock despite incredibly positive fundamental news.
It really highlights how much control passive flows have over individual equities today.
But let's take that concept one step further. Right now, passive index funds run the baseline, and active institutional managers, the ones picking stocks based on M&A or AI infrastructure deals, provide the price discovery. But major institutions are actively racing to deploy artificial intelligence to automate their active management desks too.
Oh, absolutely.
So if passive index rebalancing is already fully automated, and we are rapidly approaching a world where the active stock picking is completely handed over to AI algorithms as well, what happens to the market?
That is the ultimate end game. I mean, if AI is running the buy programs and algorithms are running the passive index flows, human sentiment gets entirely removed from the equation. We could be heading toward a marketplace that just mechanically trades with itself, completely detached from the fundamental reality of the companies it claims to represent.
It's a wild thought to leave you with.
Yeah.
If the algorithms are the only ones left in the room, you have to wonder who is really pricing the risk. Keep questioning the volume beneath the headlines. Watch that 7,370 level like a hawk tomorrow. And thank you for joining us on this deep dive.